Okay, so this is chapter 6, where we're going to be looking at inventories and cost of sales. First, we're going to be looking at, again, just kind of a review of some of the terms we've seen before. When we think about merchandise inventory, again, this is relating back to chapter 5. We're going to be valuing that inventory that we've done in chapter 5. And now in chapter 6, we're going to be placing that value and figuring out where did that amount that it's worth come from. All right, so the first thing we have to think about is what is included in that merchandise inventory. So it's going to include all goods that the company owns and holds for sale. So that doesn't matter if it's something that's, in our warehouse or in someone else's. If we own it, that's what's included in merchandise inventory. We have to look at a couple of things that are a little bit different, and those are going to be goods in transit, goods on consignment, and goods that are damaged or obsolete. So when we look at goods that are in transit, we have to think about, does a purchaser's inventory includes goods in transit from that supplier? Well, it depends on if it's FOB shipping point or FOB destination, which tells us if that ownership has passed to the purchaser. And if it has, then the goods are included in the purchaser's inventory. We can look at this and see based on FOB destination or FOB shipping point. So goods that are FOB shipping point are included in the buyer's inventory once the items are shipped. If it's FOB destination, it's included in the buyer's inventory after they arrive at their destination. When we think about goods on consignment, so those are goods that are shipped by the owner, called the consignor, to someone else called the consignee. The consignee sells the goods for that owner. The consignor is going to continue to own those goods and report them in their inventory. The consignee never reports consigned goods in their inventory because it's not their inventory to sell. All right, we look at things that are damaged or obsolete. So those are where, we're going to be removing them from inventory because they cannot be sold. So if they cannot be sold either at full price or a reduced price, then we're going to remove them. When we think about their net realizable value, we can include, we're going to be looking at their sales minus the selling costs. And for those, we're going to be looking at the sales price minus the cost of making that sale. When we determine that it's damaged or obsolete, that is when we're going to actually record the loss for that inventory. All right, so let's look at what's included in the cost of merchandise inventory. So, we have our actual inventory cost, the actual inventory that we are buying. So we have the physical inventory. That's one thing that's included, but we can have some other costs that are included as well. So some of those can be shipping costs. It might be costs to store our inventory. We might have insurance to get it to us and protect it. And then depending if it's coming from another country, we could also have import taxes. So when we're thinking of those, we have to make sure that we have adequate internal controls over that inventory count. And we're going to talk about some of those things that we can do to make sure that we have things in place. So one of the things we can make sure is that we have pre-numbered inventory tags. We can make sure that the people that are counting do not have responsibility for the inventory. We can make sure that we do verifications of the counts that are being done so that we're not just relying on one initial count, we are verifying more. We want to make sure that the condition of the inventory is appropriate. And then we can also have someone that kind of confirms by doing mini audits of the inventory that has been counted. So those are all different types of controls we can have in place. All right, so let's look at the different types of methods that we can have as to how we're going to value this inventory. So there are 4 main methods we're going to use. We're going to talk about each of them in more detail. The first one is called specific identification. The second one is called first in, first out, or FIFO. The third one is called last in, first out, or LIFO. And the last one is called weighted average, or sometimes it's called average cost. And we can see over here to the right what percentage are typically used by companies. All right, so let's look at the individual methods and kind of talk about what they're used for. We can see on this slide that they have an example of FIFO, LIFO, and weighted average, and it kind of shows you the flow. So this is one sheet that can be helpful as you're trying to analyze how those costs are going to flow. We're going to go back again. Remember, we're looking at inventory, which is all inventory available for sale. So just a reminder, this one we're including beginning inventory plus any purchases gives us that available for sale. We subtract out ending inventory, that can give us the amount of cost of goods sold, or we can subtract out cost of goods sold to tell us what is left in ending inventory. All right, so when we're thinking about the flows of our costs, when we have things that are purchased, and again, we're thinking, identical items that are purchased at different times, sometimes they can be purchased at different costs. So we had to figure out, well, how do we account for that in our financial statements? And it's going to be through our inventory account. We're going to be recording the cost of goods sold and looking at the cost of our actual inventory that goes in. So we have our balance sheet side that shows the ending inventory, and our cost of goods sold on the income statement that shows the flow of inventory that's been sold. Here's an example of what we're going to be looking at. This is called a perpetual inventory system accounting. So this is showing us the beginning inventory. It shows us how many we had. So you can see here we had 10 units at $91 for a total cost of $910. And we can see the next line that we had purchases of 15 units at a different cost, $106. And then we had sales. So one thing to remember for this chapter is the sales amounts that are listed here where it says 20 at 130. That is only to calculate the amount of sales. That has nothing to do with the cost of our inventory. Remember, sales and cost of inventory are two different parts of the accounting equation or the accounting entries when we do them. So sales is only related to what we're selling to our customers for. We are accounting for our inventory cost. So we're looking at what did we pay for it to account for the actual inventory value. So again, this is just one method to kind of show you, and it shows at the end the goods that are available for sale, how many units are available for sale, how many units are sold, and how many units are left. All right, so let's talk about the different methods. The first one is called the specific unit cost or the specific identification. And this is used when we have something that is more unique or easily identified inventory items. And one that I use most commonly when we think about car dealerships. They have their own type of inventory because every car has its own features and specs. So every car is going to be valued in their inventory individually. And when you sell it, you're going to be selling that specific car. Same thing with jewelry and real estate. Doesn't mean that you can't have two of the exact same thing. It's just you're going to account for them individually as their own item. And here's an example of that. So what we see, we have an item that we're matching with a specific purchase, and we need to record the sales of exactly what we sold and when. So, for example, if each bike had a serial number that could be used to track our costs and computer cost of goods sold. So they give us an example here that we had 55 units available for sale, which gave us a total of $59.90. We sold something on August 14th. We sold 8 that were at $91 and 12 that were at $106 for a total of $2,000. And on the 30th, we also had sales. We sold 2 that were valued at $91, 3 at $106, 15 at $115, and 3 at $119 for a total of $25.82. So it gave us total cost of goods sold of $45.82, which left us with ending inventory of $14.08. So the difference here with specific identification is you're selling a specific item out of your inventory. It doesn't matter what order it came in, you're selling a specific item with a specific identification number. All right, so let's look at the more common methods that we're going to see. The first one is first in, first out. This is also called FIFO. FIFO assumes that the oldest items are sold first. So the first thing you bought is the first thing you're selling. So first thing in is the first thing out. So that means that the oldest costs are going to be in your cost of goods sold. And that means that your newest costs, or the things you bought more recently, are going to be what's left in your ending inventory. So let's look at an example of this with actual items. All right, so if we have beginning inventory, we have 3 shirts that are valued at $10 each. And we buy 5 shirts that cost us $12 each. So the first 3 we paid $10, the last 5 we're paying $12 each. So if we were to sell 4 shirts, how do we assign those costs for first in, first out? Well, the first things we bought are the first things we're selling. We bought the $10 price items first. So we're going to sell them first. We're selling 4. We only have 3 of them. So we're going to sell all of those. And then we're going to go into the next cost bucket, $12, and sell 1 of those. Now remember, the sales price that we're selling to the customer, that's only to calculate sales. We're not using that for our inventory value at all. All right, so what does our information look like then? All right, first in, first out. So we're selling 3 $10 ones and 1 $12 one. We're going to add up that cost. That's going to give us our cost of goods sold. And we're going to get $42 as our cost of goods sold. 10, 10, 10, and 12. 30 plus 12 is 42. And that's going to leave 4 $12 shirts in our ending inventory. So our ending inventory is $48. Okay, so what does our entry look like? Well, we've seen the entry before. This is just how we got the numbers. So we have sales. This is where that $20 per shirt comes in. What do we sell it to our customers for? Remember, the amount we sell it to our customers for is higher than what we bought it for. That's how we make a profit. So we have $20 per shirt times 4 shirts that were sold. Our sales revenue is $80. We're selling it on account. So we're debiting accounts receivable and we're crediting sales revenue. Then we have our adjustment of inventory, where we're debiting costs of goods sold and we're crediting merchandise inventory. This is for the cost that we had for our cost of sales, which we just calculated was $42, was the cost of goods that we sold. All right, so our sales was $80, cost of goods sold was $42, and our gross profit is $38. Remember, sales comes from the price we sell it to our customers for. Our cost of goods sold comes from the price we paid for it, and our gross profit is the difference between what we sell it for and what we paid for it. This next one is just another example showing you the flow using perpetual inventory, where we're looking at the cost or the inventory in the beginning balance plus what we purchased minus what we sold, and getting down to that total cost of goods sold and that ending inventory balance at the bottom. So it's just another example for you to have. All right, this is where we're going to stop for part 1, and we're going to continue in the next one doing LIFO.